we've got some conflicting information in terms of the yield curve being inverted, copper breaking to the upside, oil being quite resilient, liquidity coming up and going up in the market. It's some mixed readings here. Oil, on the other hand, it's a completely different ballgame. These guys are inflecting right now, and they are literally going to buy billions of stock back. They're going to shrink share counts like this. They're going to aim massive amounts of money back at buying back shares and dividends. I also think the markets are forward looking and seeing the same thing, I think, of what I'm seeing, which is we've got a wall of takeaway capacity coming. We've got a demand that just keeps raging forward for natural gas. You know, these companies are going to be so profitable when this does all kind of come to fruition with all these LNG terminals coming online.
Hey guys, welcome to Capital Cosm. Today I have a channel favorite. It is Andy from Finding Value making his return. Hey Andy.
What's going on? Thanks for having me back on.
Of course, man. Well, hey, nothing in this video is financial advice, you guys. Neither Andy nor I are financial advisors, so please do your own due diligence. Andy, let's just jump right into it. I did ask my Twitter audience, my X audience, if you want to call them that, whatever you want to call them, to send me questions for you. So we've got a list of questions that we can go through. But before we get started, I want to ask you, what is your general view of the market at the moment?
Yeah, it's a good question. We've got an inverted yield curve. That's one thing I do look at. We've got housing completions that are up at like 1.7 million. Housing starts are above 1.5 million. So the housing market's pretty strong. We've got the inverted yield curve, which is you could say the 2 and 10 yield curve, which generally occurs when you get an inflationary impulse, rates go up, and the yield curve inverts. You generally see next a slowing of inflation and then a potential slowdown in the market. That's generally the business cycle that we go through. But the housing starts are not necessarily complying with the slowdown. They still look pretty strong. Completions are very strong. And that's where I think people are getting messed up. Even myself, it's a difficult read here because we've had the longest yield curve inversion, I think, in history now. I think it's over, can't remember the exact amount of months, 18 months or something like that, which makes it the longest. And people have been expecting that to basically uninvert and have a recession crash. And with the data that I see or that I look at, things remain strong. And it looks like to me that liquidity is coming back into the system. Oil's strengthening again. And I think we could have another inflationary kind of move to the upside here, which goes against where that yield curve would suggest we're going, which is a pullback or recession or a slowdown in the market. So when I look at all this, and if Powell does lower rates, he's lowering it into oil strength and potentially inflationary pressures. That'd be an interesting move on his part if he were to do that. So with the yield curve inverted, generally what I like to look at is precious metals. That's generally the lowest risk approach given where we're at in the cycle, where the yield curve is located. But that doesn't mean that oil can't still go higher, and it doesn't mean that a lot of these inflation areas can't go higher either. We've also seen copper breakout to the upside. That's looking pretty good. Generally speaking, that almost coincides with the economy getting stronger, at least the demand for copper. And if it remains broken to the upside and we start moving on up, that's generally a strong sign of the economy. So we've got some conflicting information in terms of the yield curve being inverted, copper breaking to the upside, oil being quite resilient, liquidity coming up and going up in the market. It's some mixed readings here, and the way that I'm going to play it, stay long the inflation trades, ride through whatever slowdown. If it does occur, I'm going to ride through it. So that's kind of the way that I view it. And trying to time this stuff, I think Peter Lynch is completely right with a lot of his quotes and trying to time these markets that more money's been lost trying to time a correction than the actual loss in the correction itself. So I think that's a great quote to kind of think about as the yield curve seems like it wants to stay inverted for who knows how long. So my current thing is inflation still in the system. I don't think it's gone, and I think commodities are still cheap.
What's the president's precedence for something like this? At any other point in time, maybe any other place in time as well, where you have an inverted yield curve as well with all of these inflationary pressures. Is there anything that you could point to in history that's kind of similar to this?
Well, almost every time the yield curve inverts, you get inflationary pressures before it or during it. So the short end of the curve moves up faster than the long end of the curve, usually. They'll raise rates like the Fed funds rate and stuff like that, and the short end moves up. The yield curve inverts, and that inverted almost every time before a lot of these crashes. It inverts also with the real estate market. So the real estate market goes into an expansionary phase. It starts to produce housing starts and completions over, I'd say about 1.3, 1.4 million housing starts. If you're over that, it's an expansion phase. Generally, that kicks up the inflation in the system because more credits being created faster than the supply of oil and commodities and stuff like that. And then the yield curve inverts almost always. And then when we go into a hyper supply phase of real estate, we go into a recession when we build too many homes and things start to collapse from the credit side. Almost always the yield curve goes up, and then we build too many homes, we get a slowdown, unemployment goes up from construction and stuff like that, and then the yield curve uninverts. But what's different this time around, and this also occurred in the year 2000, you can get some of the slowdowns without the real estate market. It is possible where the real estate market's like in a mid-cycle wobble, where we slow down a little bit in housing starts, and then something in the system because of the increasing of interest rates pukes on itself, basically bankruptcies or stuff like that in businesses or some area of the market that is in a bubble or weak, basically collapses, like the tech bubble in 2000. We also saw a little bit of housing starts drop during that period. I think we call that a mid-cycle wobble in the real estate world. So I think with the housing starts going up, if they continue to go up, yeah, I don't think we just haven't seen a recession with the housing starts going up and unemployment staying low. So historically, I would say almost every cycle had it. 19 early late 60s, early to mid 70s, 1980s. That all those crashes, they were all real estate crashes. Boom, boom. We had it in 2007 to 8. That was a real estate market crash. The tech bubble was not driven by uh, necessarily by the real estate market. 1990 was that recession was a real estate driven. 1991. So yeah, there's a lot in history that are the yield curve inverted before those, and then uninverted during the slowdown or crash.
Gotcha. Well, hey, I promised we'd get to the questions. Let's go ahead and ask our first question. This is from the Warren Buffett spreadsheet. And he says, can he elaborate about and show examples of charts and stocks with ideal fractals? I mean, I think he means that a stock with an already big earlier price move that pulled back has an even greater potential on the next move versus a stock with a smaller fractal. So,
I think I know what he's talking about.
sure.
Let me cue this up real quick and get you what I think he wants here. So I can share my screen, I think.
Yes, sir.
Here we go. So this is a company that I talked about historically, SM Energy. That's the one that I posted on the website or on the YouTube channel back in 2020. So a fractal is a repeating pattern that occurs over time. So it's like a first wave or leg higher, and then it pulls back. We see these, we call them fractals. It's a pattern that repeats over and over, sometimes on different time frames. This is a fractal where all of the companies moved in the beginning of 2020. I've got three different companies here. I've got SM Energy, which is the main chart. I've got CVX, which is this orange line, which is this guy there at the bottom.
Mm-hmm.
And then I've got Meg Energy, which is a Canadian company here. And you can see that they all create basically this upward move and pull down, every single one. And you can see on the bottom there that it didn't really go up very much, the first impulse move higher. Meg Energy did an impulse move, but it showed a much larger impulse move from bottom of 2020 to the peak. And then we can see SM Energy was just an absolute rocket ship. It went up about 333% from the bottom to the first top of the fractal. And one way that I sift through or sort through stocks is I look at the fractal differences between companies in their chart patterns. And
Hmm.
most of the time, if this fractal is larger than, say, this one here, and say that from this one here, a lot of the times the move that precedes this fractal in the beginning will be a larger move at this bottom point, which could be considered almost a double bottom. So here's three. SM's got the largest fractal. Meg's got the second largest. And if I were to just back out and then rotate over, you'll see the performance of this fractal here. So here's the fractal in the beginning, and then you can see how this performed into 2021 and how these actually moved against each other. We can keep going back out, and then I'll reline it again. You can see the massive outperformance of these. And you can see Meg has a pretty decent fractal too in the beginning. Meg is up. Actually, let's go all the way out and see where these things are ending up. So this
Yeah.
is what I think is the beginning of the bull market, the first move off that bull market, the bottom here, the largest fractals, SM Energy. SM Energy is up 3,750%. Meg is up 2,286, and Chevron, which didn't really move, is up 184%. That is some of the things that I look at when I compare companies. If you're at the bottom of the market and you've got a favorable ratio, a ratio is just an asset versus an asset. And let's say the gold to oil ratio, which was incredibly favorable, both at the bottom here and at September, October of 2020. We were at a ratio of 50, 1 ounce gold, 50 barrels of oil. A historical cheap spot for that ratio is 1 to 30. So we were very cheap on oil, even in this juncture here. And I used the fractals in the beginning of this move to identify the companies that I went into in October and September. And I bought a bunch with gigantic fractals that gave me just monster returns from this bottom here. SM Energy is one of them. I am up over 30 times my money. And there's a bunch of other ones that I grabbed. Now I apply this to other sectors, and I apply it to those companies in those sectors that are down right now, similar positions to where we are here in this bottom here. And a lot of those are located in precious metals right now because the yield curve's inverted, um, and the ratios of XAU to gold are at, I would say, extreme lows, and that's where your opportunities are. And I've been looking at those fractals for those companies, and I think I've identified what I think are some of the best companies there. But that's just an example of three companies that have different fractal sizes in the beginning and the outcomes of this. What determines the fractal size, if you want to dive into that, it's generally if it's a high cost producer and how much debt the company has. And that's generally what drives the moves on the back end from a fundamental picture. I'm looking at this from a technical, but there is fundamentals behind this that are marrying up with the technicals that I've got. And that is generally the bigger the move is generally related to the company has a lot of debt, which then sells off to just ridiculously low levels. We can show you the high here in SM. This one had a lot of debt, just as an example. We had a big move up here all the way to 90 something bucks and went all the way down to dollar 50 at the bottom here. A massive move lower when this came out of cycle for this company. And it's a medium cost producer in the shale area. It's not a low cost and it's not the highest cost producer, but it also had a lot of debt. And the debt is what caused this opportunity to be so low. Could there have been a potential for this to go bankrupt at the bottom? There was the potential, and that's why people sold it so far off. And another thing I like and I look for, and it's not just fractals, but I want to see a company that also moves with the market in an upcycle. And you can see this one went from $3 to $90 in the upcycle. And then we had just a brutal bear market in it. And that's what I look for is infrastructure demonstrated success in previous bull markets. I want to see something that's just blowing out to the downside. And then I want to see a good bounce off the bottom here with a big fractal. So that's what I think he's probably alluding to is the fractals that I look at. And it is one of the things that I use to select potential investments in companies in certain sectors is the fractal bounce and the overall size of the patterns too.
Yeah. So next question is from the same person, Warren Buffett's spreadsheet, and he's wanting to know essentially how many stocks or position size. Like, what's your diversification methodology? Like, what are your position sizing rules essentially?
Yeah. So my position sizing rules are if you're going to take a big position in something, and how big is a big position? A big position to me is probably something between 5 and 10% of a portfolio. The position size is what protects you against a total loss of a position. And your position size should be something that you take into account with the potential risk reward of the company and then the probability of that occurring. So if you've got a company that has all the infrastructure in place, they've got demonstrated success in history, and then you've got a really bad market condition that basically sells the whole sector off, that could be a good candidate for a company that you want to overweight in the portfolio because they have the infrastructure in place to generate the cash. A company is more or less a commodity company is more or less a company that converts a commodity into cash using energy. That's really what it is if you break it down to its bare bones. And then you look at the efficiency that they can do it under. And I look for companies that have all of it in place. Like they don't need to create something from scratch. It's already there. The infrastructure's there. It's all put in place. And if it's there and it's just a really bad market condition and maybe they took on too much debt, that's your opportunity for a very fast and big reversal if the commodity reverses. Because again, it's the company is just converting the commodity to cash. And it's a leveraged way to do it. It's through their margins. So I overweight companies that have infrastructure in place, that have these big fractals and chart patterns, that have a high probability of demonstrated success in history. And I buy it at what I perceive to be the best potential time to buy it, which is completely like just throwing under the bus sentiment where nobody wants it. And then you wait for that sentiment to come back into favor. And when it comes back into favor and the money starts flowing back into that sector or company, that's where you make all the money. So you're doing opposite of everyone else, which is really hard to do. So big positions, are equivalent to probability of success, infrastructure in place can generate cash. The smaller positions are these ones that don't have any infrastructure in place. So they don't have a way to generate cash. So they're not a commodity business cash flow. It's broken. So that's an early stage developer or an explorer, which does not meet a criteria for me to be an overweight position. Those positions, I would probably weight something in the 1 to 3% range. If you want to go gangbusters on it and put a 5% position on it, I mean, just know that you're reaching out on the risk curve a little bit. And at least for me, it would be a little bit of a stretch. And I've done that before. If the opportunity is good enough, I would go out on the limb in a certain sector in a certain company. You know, some of these companies in uranium at the bottom of 2020, people were pretty scared, and the ratios for uranium to gold were very cheap. So I could tell with a degree of certainty that uranium was just cheap compared to history. And with the market conditions changing, at least what I thought they were changing at the time, it wasn't as obvious as it is today. I thought we were going into an inflationary environment, so I kind of boosted my position sizes in some of the uranium companies, my favorite uranium companies, and put it in those. I think certain sectors are inherently easier to make money in than other sectors. I think the mining companies are a little bit harder to make money in, just in general. It seems like there's more things that can go wrong than an oil company and a natural gas company. And I don't know why that is. It's just my experience. They seem to run longer. The oil companies and the natural gas companies, well, I'd say oil specifically, they seem to have bigger bull markets that they go up more continually than say the some of the mining companies. They just get destroyed sometimes in like gold and silver, at least historically. I don't know if that's going to be the case going forward from here on out, but it seems to be a harder play, and it seems to be like they're not as profitable. They're profitable, but they're not as profitable as some of these oil companies. And the oil companies can really grow their production pretty quickly. So I like that about them. And a lot of the companies now, they're buying back shares, they're paying dividends. Like this is a investor's dream, and they're still very cheap. So from a risk reward perspective, you know, just looking forward and what I would overweight and how I position size stuff, I think oil and gas is just a I think they've got better quality companies that are going to return money back to shareholders. I just think they're shareholder friendly. And some people, if you were to kind of like reverse it and ask it a different way, you know, I love uranium in the sector, but I'm just going to say this: it's harder to make money there because they're going to dilute you. You know, they're going to try to build these mines. So how are they going to raise the money in a high interest rate environment? And with these oil companies, you pay very little for them, and they're literally going to give you money back. So it's a different viewpoint. That's all.
Hey guys, quick pause. I won't take too much of your time, but I just wanted to let you know that if you want to use and read the same newsletter that I do, Capitalist Exploits, we have a special $1,000 discount exclusively for Capital Cosm viewers of this channel. You simply have to click on the link down below, get your $1,000 discount. Super stoked about this. I discovered Chris and Brad's newsletter, Capitalist Exploits, 4 years ago. It set me on my investment journey. I attribute a ton of what I know to that newsletter. So if you haven't already, check them out. Click the link down below to learn more. Take advantage of this $1,000 discount. You're not going to find it anywhere else. All right, now let's get back to the video. Yeah. So next question is from Metalman U308. He says, what gains does Andy expect from here in the 300 million to 1.5 billion market cap uranium companies? So like your mid cap. It's kind of like your mid cap.
Smaller to mid cap. Yeah. Well, the ratio on URA to the uranium price is pretty low. And I think we've got a lot of upside that could occur. And I think that we're very early in this commodity bull market still. I don't think we're late. I think we're like at the beginning of it. Because if you look at some of the the oil companies and some of those charts, some of them are still putting in like a right shoulder of an inverted head and shoulders of a massive one. So, and that's kind of how I gauge some of this. We've also haven't really moved too far off the bottom of the commodity to stock ratio. So looking at the overall movements, looking at gold to M2 money supply, it's still just dirt cheap. So I think we have a big, long bull market ahead of us. And I don't know if it's going to behave the same way as 2005, 6, 7. I think this is going to be a longer one and it's going to be bigger. So I would say, bottom to top, just off the cuff here, I think a lot of them could do similar things to oil and stuff like that. So maybe like 10, 20x, something like that. But that's probably out. That's still out in the future, good ways. It's not today or tomorrow.
Yeah,
It's not this year.
and it's
It's
going
not
to be
next year.
yeah, it's going to be a bumpy ride too to get to that 10 to 20x. You might go up 2x,
Yeah,
you might come
and
down 30-40% correction, repeat the process over and over again over the next several years.
yeah, I think the uranium space, I think, is going to be a rough ride. I think in other sectors it might be a little bit easier because they still have to raise cash. They have to get money to build these mines. They're still very early in developing their mines. This is like I can't even name too many companies that are going to come online in the 2020s. I mean, there's probably a few, but I don't think the majority of these companies are going to come online in the 2020s. So that's a long way away. I mean, we're 2024. It's probably 5, 6 years for some of these guys. There's going to be some early ones. There's a handful, but I think a lot of them are going to be after 2030. So that's a long time to be waiting for a potential return. Basically, you're hopefully relying on money flows at that point, and money flows are going to come in and buy those stocks to push them on up. That's I think the case for the majority of uranium stocks in the sector. Oil, on the other hand, it's a completely different ballgame. These guys are inflecting right now, and they are literally going to buy billions of stock back. They're going to shrink share counts like this. They're going to aim massive amounts of money back at buying back shares and dividends. So that's again, what's the probability of one thing occurring or the other? And that's something I take into consideration, is probability of success.
Gotcha. Next question is again from Warren Buffett's spreadsheet. He asks, "What is your worst and best stock investment?"
Well, SM Energy, that's probably my best, especially in that period of time. That felt. I think that did it. That did a what was it? That did like a 10 bagger in like measured in months. I mean, it was like boom, 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 like all. It was just a very big ride to the upside. Not too many big pullbacks or anything like that. That's probably my best returner in terms of total returns and even my total in terms of like number of baggers up. My worst investment, I have had complete losses, 100%. I was in Nor Nickel or Norilsk Nickel for Russia, and that has been taken out. And that was a few percent. That was probably 3 or 4% of the entire portfolio. That's what my position size was, and I lost the whole thing.
Yeah,
It is
I've had a bad experience with
held or
nickel as well.
gone. So I've been wiped out completely. I've my fastest loss. Well, I had some pretty big gains too. I was short-term trading. I did some crazy stuff when I was younger. Um, okay, there was a company I shorted in coal back a while back. The whole sector, it basically was dropping like midday, and it was dropping big. It like fell off a cliff, and there was this one company that was sitting there that hadn't fallen yet. It was called KFX, which was it was like an additive to coal, and I knew that it always followed coal, but it always delayed. So I shorted KFX, and it went down like 20 or 25% one day, and I got out like right when that occurred, but it went down like another 10 or 15% the day after. I could have stayed short, but I made a bunch of money on that trade for how much my net worth was at the time because I was in my 20s. That was probably my most memorable amount of money made in the shortest period of time because I put a very big short on it. And I was not, guys, this is my early 20s, guys. This was just kind of, I was getting to learn how to read charts. I was going a little bit crazy. I even think I used a little bit of margin on that one. And I ended up making like, I think I put like 40 grand on it as a short. And I made like $8,000, $9,000, $10,000, whatever it was. Between eight and $10,000, I think is what it ended up being. And that's when I closed it out. I was like, I'm good, lock it in. And that was one of my biggest, shortest moves at that time. That was the most memorable. SM Energy was a completely different animal because I entered that not trading it, but a completely different mindset. I still hold it, and I just bought it at the bottom and just rode. But that wasn't in a short. I mean, it was in a short time frame, but that was also a pretty memorable one. And now I'm kind of, I don't know, I'm kind of numb to the whole thing. Like I don't, it doesn't. It's like, I'm in it for the long term and the short term market movements. Yeah, it's great to see it to go up. Yeah, if I get an 8 or 10% up day, that's fine. But I know that I'm in it for a longer period of time. And a lot of the times when you get these big up days, they have like a pullback next to it or something. So I'm kind of immune to it now. And I don't know why. I just am. I'm not as excited.
Yeah, I mean, you're a veteran, Andy. I mean, you've been doing this probably longer than some of these viewers here have been alive. So
Could
perfectly
be.
understand why. I mean, I've gotten pretty numb to it as well. I was just telling Trader Ferg, who I interviewed a week ago, that I barely even check my portfolio anymore. Like ups and downs,
Mhm.
daily ups and downs don't even register on my radar screen because I've already conceded to the fact that I'm going to be holding these things for years to come. So, like getting stressed out and being overly
I,
anxious
I
on daily moves isn't really productive.
I had a really bad pullback in, let me see here. That was in 2022 where I had bought some of these companies very early in, in the bull cycle, we'll call it, late 2020, and they all fell together. My
Wow.
biggest positions all pulled back a very big amount, and that did rattle me a little bit. I was like, man, I just got. I mean, it pulled back. I was down, 30 to 50% on all of those positions in a very short period of time. I think it took 1, 2, 3, 4, about 4 or 5 months, and it was just everything dropped 50% because these big fractals also have more volatility in it. And I'm still long all of those companies still. So I had a lot of money in it, and it was just boom over a 4 or 5 month period. It all kind of got chopped. And I know the response for most people, they'll be like, well, you should have sold. You should have taken some off the table. You should have sold all those out. It's like,
You don't go broke taking
no,
profits, Andy.
no. Yeah, they'll say something on the lines of that. But all of those stocks have come back. And I'm like killing it now because some of them have really taken off from that point in 2022. They're up double, over 100% from that time frame. So yeah, we pulled back 40, 50%. Some of them are up, almost 150, 200%. Like they just kept pulling past their highs because the company is making cash flow, buying back shares, and now they're really buying back shares. 100% of their free cash
Yeah.
flow is going back to buying back shares.
And,
And
and,
this is a rocket ship.
and knowing you probably
So
added in on the dip, on the
actually,
pullback.
I did.
Yeah. Because
I
that's what I would
did.
do.
It was
That's all I do. I don't try to time sell-offs. Anytime I see like a big correction like that, I just buy more. I don't kick myself and
I
say, "Oh,
bought
well, I should have just
actually.
sold at the top."
So what I did is I held that one in a certain account and I bought it. I bought a bunch in another account because I just think the reserve life is too big. The company was looking too good, and I didn't know that this company was going to turn out this good. I just knew that it had a long reserve life. It's out there, was it between 30 and 50 years, depending on production, and I'm just looking at this thing like, man, if they can get moving in an increasing oil environment, this thing's just going to be a complete cash cow. I call them cash cows. And if they are going to return this stuff back to the shareholder, this could be a really good company. And of course, they are returning back to the shareholders' money. So I just get that is what keeps me in the stock is the potential in the future for all of these returns in certain sectors. And this one happens to be in oil and gas. That's my favorite sector, oil and natural gas.
Well, so what's your kind of view on? We'll get back to the viewer questions in a second, but natural gas has been at the $1.75, $1.90 level for quite some time now. What's your view on natural gas? Just curious.
I think it's an absolute steal. And I think it's going to stay down for a while. I don't think it's going to come raging back immediately. But natural gas is we converted all of our coal power plants to natural gas. We're converting a lot of them, eventually, maybe even all of them in America. We've got liquefied natural gas terminals coming online late 2024, early 2025. We've got a small inventory in relationship to the production that we've basically brought online, the demand and production. So the inventory staying the same size, and if your demand keeps going like this, that that percent of coverage to handle volatility against the demand that's increasing rapidly is getting smaller and smaller. So your days to coverage are shrinking. And that's where I think the opportunity is because we overproduced. We had some bad, so we'll call it warm weather, which is bad weather for natural gas. We had some warm weather. We're a little bit over the 5-year average. We have a glut, and the days of coverage continue to decline from how much demand we actually have in the system. And I look at the liquefied natural gas terminals coming on late 24, early 25, and I'm just like, holy crap, like, how are they going to meet all this? Like, this is a big, this is a lot of takeaway to capacity. And if our power burn keeps going up for electricity, which it just keeps stair stepping higher every single year during the summer, it keeps going up and up and up. So I see it as one of the better opportunities because if natural gas is this cheap on a ratio perspective against all the other assets, I think this is the cheapest it's probably ever been in history. And if oil gets into a conundrum, which I think it will, I think we're going to get tight in oil, and we're switching everything over to natural gas. I think all energy is going to look very good in like a 5-year time frame. And I think eventually we're also going to get cold weather. We're going to have a cold winter, and you're going to see the price spike. It's going to go way up because our inventories on a days to cover are shrinking versus the demand. So I think it's a buy. I think it's a buy down here over the next 4, 5, 6 months. Even starting today, I would be looking at potential uh, positions in natural gas equities. Now, the natural gas equities haven't fallen that much as the natural gas commodity has. And a lot of these commodities, the ETFs or ETNs, whatever you want to call it, they roll over all these futures pricing, and when they roll them over, you get this natural decay to zero. So I wouldn't necessarily play the commodity price with some of these ETNs and stuff or leveraged products like Boyle or whatever. I'd probably avoid all those, but I would buy the equities. And I think natural gas um, is like probably one of my top picks for the best plays coming up over the next 5, 10 years. And you got to keep in mind too, Nvidia's selling all these chips that just consume power up the yin yang, and that's electricity. So if we're converting coal to natural gas to generate electricity, who's the big winner in this game? You think they're going to pile on a bunch of nuclear power plants the next few years? They can't respond that fast. They're going to burn the crap out of natural gas. They are going to burn the crap out of them. And what's even better is you've got LNG takeaway capacity coming that's just ramping dramatically 24, 25, 26, 27. I mean, it's like a straight line up. And I'm sitting here like, oh, can we even produce that much natural gas? I don't know. That's my bet. I don't know if we can produce that amount of natural gas And if we get cold winters, good luck Europe. Because I mean, we're going to be this is going to be very expensive. We could shift from a oversupplied market to an undersupplied market very quickly with just one winter
Yeah.
or a hot summer.
Yeah, so you mentioned it right there. The natural gas sector is kind of like the inverse uranium sector in the sense that the equities have actually outpaced the commodity itself. So why is that? Why have the equities kind of like maintained their high levels, whereas the natural gas futures prices come back down?
Yeah, I think well, some of these companies have a lot of hedges in place, so the impact to the pricing of natural gas doesn't impact them immediately. So they can kind of ride it out for a while. They'll hedge maybe 50% or more of their production, depends what their strategies are. So some of them are still hedged and they're making some good money. Some of them are producing more natural gas liquids. So that's like your propanes and stuff like that. And that's actually really high right now. So they're maintaining profitability that way. A lot of them pay down a ton of debt. So their debt that really hurt them in 2020 brought them down to these super low levels when they had natural gas go up to, what did it go up to, like $10 a MMBTU or something like that. It went up quite a bit. They made a ton of money and they paid off a lot of debt. So their risk isn't as bad as it used to be. So I don't think they're going to pull back as much as they used to because the debt levels are to more sustainable levels. Uh, so I think that's a combination of all those things. A little bit of hedging, a little bit of natural gas liquids production, and a little bit of debt reduction gives you a lot more stability in the markets. I also think that the markets are forward looking and seeing the same thing, I think, of what I'm seeing, which is we've got a wall of takeaway capacity coming. We've got a demand that just keeps raging forward for natural gas. You know, these companies are going to be so profitable when this does all kind of come to fruition with all these LNG terminals coming online. So I think there's also that behind it too. It's a combination of all those things wrapped together.
Yeah. Yeah. What about coal? Coal is pretty correlated with natural gas as well. What's your thoughts on coal?
I think coal's going to kill it. I think it's going to crush it. Um, I was wrong in the beginning of 2020 by not buying as much coal, which I didn't really buy any. I bought almost exclusively a lot of the natural gas companies, and it worked out very well. Just happened so. But I do think with what I think is coming, I think electricity demand is going to go up a lot. Uh, it's going to go up a lot in India. It's going to go up a lot in China, very heavy coal consumers, and it's going to go up even more rapidly in the years to come. They're installing a lot of coal power plants. I think artificial intelligence is going to really put the squeeze on electricity demand. I mean, it's going to squeeze everything in our system. It's probably even going to squeeze copper because we need to put up transmission lines and all that stuff as well. The grid systems need to be beefed up massively. So I think we're going to squeeze energy just in its entirety. Oil is going to get squeezed. Natural gas will eventually, I think, turn around and get squeezed. And then coal is like the ultimate swing producer, is what I'll call it. And I think we're going to squeeze coal too. I think we're going to squeeze the whole energy system. And uranium, I mean, obviously uranium's good too, but and we've got a great setup in terms of the undersupply. I just don't know how fast it can react to the system. Like I don't know if uranium's going to make a huge dent in the next 4 or 5 years that we don't already know about that's in the system in the pipeline. So I think a lot of this is going to fall very heavily onto natural gas and coal in the short term, and then the long term that's all uranium driven. I think nuclear power and stuff like that. But that's 2030 and onwards. I don't think that it's going to have a huge effect in the 2020s outside of maybe a couple, some restarts and stuff like that. And
Yeah.
if they can't get those restarts going, if they don't have the uranium to put in them, it's going to be more natural gas and coal demand, I think, if they don't have the uranium to put in it.
Yeah. I mean, I wouldn't want. I wouldn't want not to have a seat at the table at any one of these sectors, whether it be coal, nat gas, uranium, any like all these energy sectors. You've got to have some sort of exposure to. Like that's just my sentiment at least. Well, hey, let's get back to the viewer questions really quick. This one is from Mick. He's pretty much asking for your opinion on Bannerman. He wants to know whether it will exceed 40 Aussie dollars.
Well, I don't. So when I look at a lot of these companies, I don't necessarily put a specific price target on it, but there are ways that you could calculate a potential valuation. You could calculate it off of pounds in the ground and what those dollars are versus pounds in the ground. So last bull market, what you could give it like a 10% valuation of the spot price or the contracted price, either one. Take the spot price, do about 10% or so, and see what that valuation number is. And that's kind of a ballpark of where I might think maybe the companies might trade up to, something like that. So if we get to $200 uranium, $300 uranium, $400 uranium, which I think is all possible, take about 10%. So maybe about 30, 40 bucks a pound. And they've got what, 240 million pounds, I think, 250, 260, somewhere in there. What's the actual pounds that Bannerman has? Do you know that
Not off the top of my head.
by any chance? Let's call it 250 million. And then you multiply it by, let's say, 30. That's a 7.5 billion market cap. So whatever the market cap is, let me look real quick. Just give you
Like
guys
a little under a billion.
is it a little under a billion?
I think it's like half a billion, maybe. Let me see.
Let me look here. It's 359 million.
Okay.
So I would divide that by 359 million. Maybe a 20x,
Well,
21x
yeah.
potential.
Yep.
And the closer they get to developing a mine, they're going to, as the developers get closer to producing, they're going to re-rate those pounds in the ground to a higher dollars per pound upward. So what we see in the sector is you see Camco and some of these producers have the highest pounds in the ground rating. So whatever pounds they have in the ground, they get rated the highest for what they've got because they can produce it and convert it into cash. The further you get away from production into exploration, they have the least amount of dollars per pound in the ground valuation. So I think Bannerman, since they are developing a mine, and I think they have a good shot of developing it and getting it all ready. I think they're going to get re-rated upwards in terms of dollars per pound the closer they get to production. So I think that's probably one of the best companies in the uranium space, in my opinion. It's a great company.
Yeah, I think so. I
It's one of
think so
my
as well. Yeah, it's one of my holdings too. Um,
it's one of my largest holdings.
yeah, yeah.
Yep.
It wasn't my largest holding starting off, but ever since it's run, it's become my involuntary one of my involuntary largest holdings. Let's just put it that way. What
Mm-hmm.
are your selling strategies, Andy? This question is from one of our viewers. How do you decide when to sell? And
Yeah. So
what
I
are your
sell.
strategies?
Yeah. So here's some things that would make me sell. A company. So you've got the stock, and then you've got the business. They're two separate things. They're not the same thing. And what we're looking for is we're looking for the disconnect between the stock price and the business price. That's your undervaluation. And I buy the stock hoping that the business improves and improves under the conditions of the commodity going up because we're talking about commodity stocks and businesses. If the stock or the company, if the company is very much in debt and the commodity price isn't moving, they could go bankrupt. And if I see that they might be straining the balance sheet too much, I'm out. Like it might just be too much risk. I did go through one bankruptcy in 2020, and I got warrants and actually made money eventually on it. It just took a long and big move for me to get back to even. So going through bankruptcy or something on the lines of that, you might want to jump out if the commodity price hasn't come back and you're in a high debt company. That would be a reason to sell. You evaluate the sector with the information that you've got. you put your portfolio allocation to some companies, you're riding through it, and then you find out maybe that one of the companies is way better than what you thought. And maybe you're like, well, I don't know why I allocated this amount of money to this company as much as maybe I should have to this other one. And if you just did a misreading at the beginning, and as more information comes out and a company looks better and better, and it's of better value, and you think it has better potential returns in the future, I would sell one and reallocate to the other to kind of shift some of the balance to what might have been a miscalculation in the beginning. So that could occur with information coming out as you learn more and more information about the company. When a better opportunity comes up in another sector. So let's say you buy something's down, it looks really good. I'll just make it up. Oil's in a good situation, or uranium, you buy it. It goes on up. And you're like, okay, we're at the beginning of the bull market. You don't really want to sell it, but let's say gold shifts all the way back down, the yield curve inverts, just like we're in. And maybe you're like, you know what, maybe I should diversify a little bit into some of these companies that are just blown out to the downside. So maybe a company hasn't realized its full potential yet, but it's a monster position or something like that you've got, and you're like, I'm gonna sell a little bit off and reallocate to this other company that is earlier in the valuation stage of the process. So it's down, nobody likes it. I'll just say it's a mining company or something like that you found. It's a really good value, and you want to allocate more money than what you've got available to it. I could see someone selling it from somewhere else and reallocating to that company. A lot of the times, the ones that I do sell are my underperformers, and I usually keep my top performing companies. So what I do is I kill the dogs and I feed the lions. So I let the lions run, or the cheetahs, however you want to call it. I know I got a lot of cheetahs running and stuff. So I let the cheetahs run after they break out, and then I kill the dogs, and I might reallocate somewhere else if I were to do that, if it's just not working out the way I had planned it. A company that doesn't move with the sector or the commodity, it's kind of dead. That's another thing that I might cut. Like let's say oil's moving up and this thing just doesn't budge. It's like, okay, what's going on here? And it just doesn't go. And it's like, all right, this thing's probably dead. So sometimes that occurs. It's not that often because I use fractals and stuff to kind of weed those out, or try to. But yeah, I think that's kind of everything I can think of off the top of my head of trimming stuff if something, it's time to sell. So, and obviously, if the ratios get expensive and these companies get expensive and the sector gets expensive in the commodity, I would definitely sell then if the whole market condition is changing. If the under, the if we're getting over investment, if we've got full inventories, or inventories are changing in the opposite direction. Another thing that you can look at is if the driver of credit expansion ceases to exist too, that'd be another reason to sell, which is if credit from the real estate market and expansionary phase ceases to continue to drive, or the debt crisis, something with the debt crisis gets resolved, it may that those credit drivers may not drive the commodity price up anymore, or the dollar down, I should say, because a lot of these commodities are priced in dollars, and if the dollar's falling, it causes people to shift money into commodities and inflation sensitive assets. That'd be another reason to sell. There's a lot of reasons, I guess, after I think
Yeah,
about them.
clearly.
But I think that's it.
Yeah. Well, hey Andy, thank you so much for coming on, man. It's always a pleasure. It's always good getting your wisdom, your insights. Tell people where they can find you.
Yeah, you can find me Finding Value Finance on YouTube. I have a YouTube channel, and then I also have a website, finding-value.com, where I go in and dive into these companies that we're talking about, and I show you exactly how to do this fractal analysis, how to do all the ratios, technical charting training, lots of trainings on all this stuff, and my viewpoints and strategies on setting up portfolios and stuff like that. I'm not a licensed or registered person to give advice, but I can share what I'm doing, and that's what I'm doing is I'm sharing what I'm doing, how I'm setting it up. And I think a lot of people have learned a lot about picking companies, what to look for at buying bottoms and stuff like that. And that's where the value is to see someone do it real time, who has some experience doing it. And then you get to see like, oh, that's the way that it's supposed to be. You're not supposed to buy it when it's going vertical. You're supposed to buy it when it's like basing out, breaking a falling wedge or a pattern, and the ratio is cheap, and you get this, maybe I'll say, confluence of events where everything kind of lines up for that sector to outperform. So yeah, that's how they can reach me.
Yeah, I mean, I figured if everyone bought at the bottom, there wouldn't actually be a bottom to buy anymore. So you've always got to find the hole in human nature to exploit.
Well, I think what a lot of people, we're all in the same YouTube communities, and I think we all think very similarly. So we think that if you're in the community, that everybody outside that community thinks the same way. But I think we're just in these niche kind of
Yeah.
areas that like everyone kind of thinks similarly, but everyone outside of us, I mean, no one's
Yeah.
thinking about
Are you
uranium.
saying we're in a
You go to
cult?
like the mall or something, they don't even know what uranium is.
Yeah. Yeah.
So
Very true. Very true.
that's the way I think about
Yeah.
it. Yeah.
Well, any other closing thoughts before we wrap this thing up?
No, not really. I think we went over quite a bit, and hopefully this information is valuable to you guys, and it does something for you. I'll
Cool.
say.
So check out Andy, you guys. I've followed Andy for a few years now. I love his info. I love his insights. And if you enjoyed this content, be sure to give us a like. Comment down below. Let me hear your opinion. Would love to hear what you guys have to say. Also, yeah, all that stuff is in the link down below for Andy, Finding Value Finance. And yeah, guys, I will see you in the next episode. Bye, y'all.